Hi and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi and welcome to the podcast. It's 30th of June 2022. My name's Campbell from Prosperity. I'm here with Melanie Peter, also from Prosperity. We're both in the Brisbane office actually, which is handy. And today we're going to talk a bit about lending advisor and what Melanie's role is and how she can help when it comes to interest rates, loans, etc. But also maybe delve into what's happening with a few interest rate rises at the moment and what that means for you and what kind of different options are there for lending. So Melanie, thanks for joining us and welcome to the podcast.
Thank you, Brendan.
First of all, I guess lending advisor is the term we use most common with, but obviously mortgage broker, similar term.
Yes.
Talk to us a bit about why should people use a mortgage broker / lending advisor and what are some of the benefits?
I guess there's probably four reasons why you would use a mortgage broker or lending advisor. Predominantly, we can search for the right loan and product as well as the right rate. So there's obviously a myriad of products, lenders, over 40 on the market, and we're well trained in all of those sort of policies. So we look at your requirements and can find the right product that will fit that, as well as we can apply pricing discounts, find the best rate and compete in that space.
And I guess it's not always, from my understanding, and I'm sure you'll know more, but from my understanding, it's not always just, X bank is better than Y bank, or X bank is a cheaper rate, or Z bank is this. I think it depends on the appetite of the bank, doesn't it, as to whether they're aggressive in that area or don't want more of that type of lending. Is that sort of still relevant, how that works?
Yeah, that's still relevant. Lenders all have sort of an appetite and a certain type of appetite for different loans and products and what you're looking for. And I guess that's where we come into play, that we simplify the process and save time. So rather than if you went to a bank and they, might look at it and go, yeah, we'd consider it, but then, they decline it. We look at a range of different lenders and make sure that it's going to fit to, obtain that approval. And so it just simplifies the process.
And probably different rates as well. I guess the more aggressive a bank is, the better their rate would be typically and better their, how their systems work. And I guess if you're talking to the banks regularly and who's got the appetite and who wants it, who's doing, speed is sometimes important, I know as well.
Yes,
talked to me
exactly.
about that with a few clients recently where we might be, and we won't throw a name in there, but X bank might be, 10-week turnaround, but Y bank might be 2 weeks, we can get this out and get it done and it's going to be a good rate. So it's often knowing that inside, having that inside knowledge, I guess.
Yeah, absolutely. So there's obviously some there's a list of banks that probably have the fastest SLA. So we can say if that's a requirement, if you're purchasing and you need something to go through urgently, then, that's a requirement that we would then say, these are the banks that have the fastest SLAs. Whereas some banks won't pick up a file for 2 weeks sometimes. So that's not, an option when you have a finance clause of 14 days, for example.
Yeah. What's the SLA acronym? I don't know that one.
Oh, so that's a service lending standard. So,
okay.
Yeah, so it's sort of like the banks will say, we'll pick up your file in 1 day or pick it up in 5 days. So we have like a little Excel spreadsheet that we look at on a regular basis.
Yeah, so it's working out as you said earlier, what type of loan and what product will suit the customer depending on rate, speed, everything else. And I guess probably the other thing while we're talking about that is how do banks, just something to talk about, how do banks assess a loan? Because it's I guess, I always throw out the terms of your serviceability and your LVR are kind of the two things banks look at, but there's that other thing where they when they're looking at your serviceability, it's not just the current interest rate, it's higher than that, isn't it, when they assess it?
Yeah, correct. So within the serviceability side of the calculator, we'll put the actual rate in. So if the bank gives you 3%, we put that in the actual serviceability calculator and it adds 3% on top. So they have a buffer. So they'll assess you at a 6% interest rate that you actually can afford the loan. So they're sort of got a contingency plan that if rates did increase on the variable, naturally with a fixed rate, it's sort of fixed and assessed on the fix for that sort of period of time and then rolling into what the standard variable would be. So, and yeah, so that's how a fixed loan would be assessed. But
Yeah,
yes,
so it's
they
not
still have
just
a buffer, even with fixed rates, they still have a buffer because you might come out of that fixed period in 3 years into the standard variable. So they allocate a buffer with every assessment.
So it's not just you going, oh, this would be my, if it was a 3% interest rate, this would be my repayments on $1 million loan. Oh yeah, I can afford it. You've got to kind of work it out on maybe 6 or 6.5, depending on what buffer. And do banks have different buffers, or is it all about 3%?
It's all about 3%. Some might have some minor, sort of higher buffers, but generally they're all around that 3%. That's set by APRA. So yes. APRA, the regulator. So yeah.
So that'd be the serviceability side of it. So working out, well, we know you get X amount of income and we know your running costs or your expenses are this. Could you then afford this loan based on that, having that extra 3% on top of the interest rate? Would you then be able to afford it? That's the serviceability side.
Yes.
And what's the LVR, the loan value ratio? Talk us through that and how that applies. And obviously there's different LVRs for different industries as well.
Yeah, correct. There's a variety, and there's even per security. So different type of securities might attract a 50 to 70% LVR. So you can only borrow 50 to 70% against the property. So you either have to have equity in other property or the, cash to be able to complete the sale. Yep. So we look at, the security, the postcode, how much will the funder lend in that area and against that security. You can go right up to 95%. And some products, even for an owner-occ, you can actually apply for 95% and capitalize the mortgage insurance and get 100% LVR. In those type of products, you have to have like a category 1 property, so metro type areas in all the states. So they're very, it's sort of each product has, like a different LVR and a, different category for the actual security. So we have to check all that off as well.
And different rates sometimes. So I know doctors sort of get, on certain banks, doctors can go 95% LVR, whereas the common punter out there might be getting an 80% LVR. So there's a bit more appetite to lend to someone who I guess the banks would feel are less risk. Is that a fair way to say that?
Yeah, correct. And for example, over 80% normally attracts mortgage insurance fees. But with doctors or Medico, it won't attract those fees. So they can go up to 95% without that cost factor.
With certain banks.
Yeah, with some banks, not all banks. So so again, there's a whole range of, and it's working out the funds to complete. So the funding position, how much, that you require for stamp duty and to actually complete that sale and be able to have enough cash flow as well for that.
Yeah, so if it's a residential loan, it's not like going, well, at the moment I pay $1,000 in rent. Well, obviously I can afford $1,000 a week. It's a lot more complicated than that.
Yes,
and obviously some maths behind it. I guess I'm probably at the moment thinking residential loans, but what other types of loans do lending advisors assist with, and where can you be a benefit there? What are the different types?
So business loans, for example, so working capital, cash flow lending. So in some industries, like engineers, accountants, doctors, different things can actually obtain cash flow lending and business loans. Some will be secured against property and some's unsecured. So again, it comes down to the client's requirements, but they'll look at the cash flow of the business and lend against the cash flow for a certain amount. So similar to an overdraft, but it's like called cash flow lending. Yep. So there's a whole range of business products naturally for a business. So we can look at all of that, look at all the different lenders and who is providing, like the type of loans that business would require. Yeah, if you're purchasing a business, like if you want to purchase a business as well. Yeah. So each bank has an appetite for different industries. So like in the pubs and hotels, for example, there's only a certain amount of banks who have appetite and a certain loan to value ratio, but they'll secure it against the business. And they might secure 50% against the business and the remaining against a property. So it's sort of, again, different structures. And then there's commercial loans and self-managed super fund lending. Yeah, there's a whole range of different products outside of residential lending.
Yeah, the commercial and obviously residential and business are more common. The self-managed super fund I'm probably not seeing as much these days, but still, is there a few banks that still have the appetite for that?
Yeah, there are. So there's a couple of banks. There's some really good rates at the moment with self-managed super fund lending. Most of them are commercial loans where the client's business is renting the property from the self-managed super fund loan, and normally commercial type facilities. So sometimes around the 4% is the, interest rates coming in, starting from 4% in that space. So with, like low fees, but there's a lot of funders that moved out of that space. If people, it's probably a good idea to review, because a few years ago, Westpac or some of the big four moved out of it all, and the rates are quite high if you're sitting in that sort of product with them at the moment. Whereas, it's a lot of the funders who are in that space have sharpened their interest rates. So it's a good time to review.
Yeah, it's one of those things, I guess, the loans are never really set and forget. It's particularly if you're on a variable. Sometimes I know a few clients, and when we were talking to just yesterday, I think without mentioning names, Melanie, the bank seemed to have let it go a bit and let it slip, and all of a sudden the rates crept up, and it's like, well, you've really got to be on top of it and managing it, and that's where I guess a call to you can help that out, where you can. And it's hard to know what are the banks offering at the moment. Is this still a good rate? Particularly, there's been a few rate rises, and actually that's probably a good thing to discuss as well. The rate rises have come out. How are they? Are they all passed on now in full? There's been 2 of them, I think, in the last 2 months or 3 months. Is there, and silly question, is there more to come? Well, who knows, of course, but assuming they are, the banks normally are pretty quick to pass them on. And have all of them passed on the existing ones, or all the majors?
They have, yes. Yeah. So that was all completed by all the banks by the 21st of June. They're all fully passed on. They all did it at different stages, but those 2 rate rises have now been fully implemented.
And it would be a silly question for me to ask which is the best bank, because that changes regularly. And obviously, depending on the product, depending on what you need it for, and depending on who the person applying is, that will vary all the time, which I guess is where your information becomes invaluable. But as a rough guide, what would what's the residential variable loans? So, the headline stuff we talk about for someone buying a property, that seems to be the stuff that makes the news, not the rates for businesses or commercial, but residential loan, average person out there with enough LVR and serviceability, and say they met all those tests and they could wait 12 weeks for something to be processed. What rough rates are we getting at the moment on variables?
Probably still getting some rates just under 3%, but generally it's around 3%. So some of the standard variables are 5.8%, but we're applying pricing discounts. And so some of those rates are coming down to sort of 3 to 3.2% off that standard variable rate. So, so there is still some pretty good cheap rates that you can apply for. If you went direct to a bank, they will still, they might put you into that standard variable. But they might offer a pricing discount, but we generally will put in pricing discounts for a range of funders, and be going for the best and making them compete. And letting them know we've gone here, this is the rate we've received. Can you offer us something better, basically, for our client? Yes.
You do the hard talk on behalf of the client.
Correct.
And what about fixed sort of stuff? What a 3-year, 5-year fixed? They're obviously a bit higher, I'm assuming, because everyone seems to be saying the rates are going up. Yes,
they are. So I guess it depends on whether you're looking at P&I or interest only, but sort of P&I has gone, up to that sort of 3.7 to 5% fixed between 3 and 5 years. So they've sort of, increased a fair bit. And the interest only, is obviously a little bit higher again, but definitely in that sort of 4 to 5% fixed rates at the moment.
That's a very good point, I guess, that interest only is typically a higher rate than principal and interest, because you're not reducing any of the debt, you're just paying interest only, and there seems to be a bit of a surcharge on that, as I'd call it. But they're paying, you pay a bit extra to have that. So a lot of different ways. It's really hard to assess, I guess, if you just look at 2 numbers. It's a bit hard to say, well, this bank's at 3% and this is at 3.2. But is it the residential property? Is it an investment property? Is it P&I? Is it variable? Is it fixed? Is it There's a lot of different moving parts, I guess, there. And you mentioned that pricing discount. So you're getting, sounds like about 2.5, maybe pricing discount on. So if a bank's saying 5.8 as their headline rates they've got, you're getting it down to 3s. That's typically because, I guess, you're applying this pricing discount that you've got because you're a lending advisor / broker in the industry that knows how to get those rates. That is obviously a good win for a client if they're coming to you and we're getting our loan across. We're getting it at a better rate where they're paying less on their loan, and typically, I think most of the time you end up getting a set percentage of commission effectively from the bank, which means that you're getting paid for your hard work to get it done. but the client's actually getting a better rate than they can get anyway. And it's sort of it's a bit of a no-brainer in the end, isn't it?
Yeah, correct. And even every year, what we do as well with existing clients is we'll apply for another sort of pricing discount in sort of, you've got to wait 12 months with the lenders, but then we'll sort of try and get, a little bit extra again in 12 months time, 2 years. Just always keep sort of applying with that existing lender to see if we can keep having them sharpen the rate. If they don't, then we'll review it. There might not be any change because it sort of might still be one of the best rates on the market, but we definitely will review and look at them. And if we can get further pricing discounts, we do.
And that's important because even with, back, let's say 50 years ago, you used to go to the NAB or Commonwealth or Westpac or wherever it was, and you'd take out a loan and you'd have that for 30 years and just pay it off. And nowadays, that's just not the way it's done, because even if it's within, say, one of those banks, say it was a Big Four bank, the loan you've got with or the product you're in might actually move and go up in interest rates. But yet if you just negotiate back with the bank and move it again, it can come down lower, even though it's with the same bank. So they don't automatically give you the best price. And gone are the days of, I know the bank manager and we've been banking with him for 20 years, and therefore we get the best rate. I mean, that just doesn't happen now, does it?
No, it doesn't. And often, sometimes clients, are like, I've been with the bank for 20 years, I can afford this, I've never missed a payment, so, they think that, the loyalty.
The after them.
Yeah, correct. And that's not always the case. And policy changes, so then they might not fit that policy either, so they can't provide further lending. And I guess that's where we come into play, where we can look at other lenders and different policies and ensure that, again, they're in that right product, right rate, and the right requirement for their loan.
Yeah, absolutely. And then obviously if it's a fixed period, you've got to weigh up whether, if you start pulling out of a loan early, there might be some break costs. So it's important to assess it all and see where it's at. And it might be, I'm fixed for another year, but then it comes off. And the rate that you come off at typically seems to be a bit higher than it normally should be. And if you don't make the phone call, it stays a bit higher. But yeah, it's worth probably considering it and getting someone like you to assess it and have a look at it and say, well, yep, it's a good rate, stick with it, or no, it's not, we can fix it. What are your requirements? And let's go for
it. Yes, absolutely.
Thank you very much for joining us. I think we'll try to keep these fairly short in the podcast, so short and sweet sort of ones. Melanie, if people want to get a hold of you, how do they contact you?
Email's best to contact me. So mpeter@prosperity.com.au.
Perfect. And obviously I'm the same as always, bcampbell@prosperity.com.au. Thanks for joining us today. Really hope you enjoyed the podcast. And obviously for more information for Melanie, just contact her or check in the notes against this podcast. There should be some more details in there. And for more information about Prosperity and everything we do, feel free to jump on the website, prosperity.com.au. And hopefully you'll also like and subscribe and join and give us a few stars for this episode. And it's the end of the financial year. So in my words, I'll see you in the next year. Thanks, Melanie.
Thank you.
Thanks for joining us for today's podcast. Hopefully you liked it. And if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.